Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, and today we're taking a deeper dive into the YieldMax Target 25 ETFs. Particularly, we're going to look at the NVIDIA and the Tesla version of the Target 25. We're going to focus on what the Target 25 concept actually means, how the strategy is designed to work, and what we can and cannot conclude from early data, and the key risks you should understand. Now, I get a lot of questions from viewers about the YieldMax Target 25. Are these good funds to get into? It makes a lot of sense. And we wanted to break this down because I think there's a lot of preconception of what these things are and what they are not. So we're going to deep dive into that. But before we do, I got to do a big shout out to all of our Patreon supporters and all of our YouTube members. Thank you so much for supporting the channel and helping us keep this thing alive. And if all of our YouTube subscribers, welcome back. And if you're not a subscriber, don't be afraid. Hit that subscribe button, hit that bell notification. It helps the channel across the board, and you don't want to miss a single one of our episodes. Let's get into today's deep dive into the YieldMax Target 25. Now, notice to all viewers, past performance does not guarantee future results. The information provided in this video is for educational and informational purposes only. Remember that this is not financial advice. This is, if you need financial advice, always contact a financial advisor. So let's start and get into the Target 25 really means. Now, what does the Target 25 really mean? Well, by definition, the management objective guiding the portfolio strategy to achieve approximately 25 analyzed distribution rate. Now, that target is not guaranteed. That target is not yield. That target is not total return. What it is a portfolio management goal. The subject to market conditions and a distribution strategy objective. It is not a promise of a return. It is not a promise of a guarantee. It is not a guarantee of an income stream. Its actual payouts may vary and may even be zero. So the key phrase is the annual 25% target. And that's what's trying to promote and get you involved into the funds. That's why we wanted to do a deep dive on these two, which are the most popular standalone stocks that are out there in NVIDIA and Tesla. So we want to see, is this thing actually performing or not? Now let's cover the basics. The NVIDIA fund and the Tesla fund have inception dates of November 17th of 2025 and a 0.99% gross expenditure ratio. So they're both very new. Both funds intend to pay distributions weekly, but again, remember, those are not guaranteed of distributions to be made. They may also use return of capital as part of their distributions. Here are the core mechanics of how these funds operate. These funds aim to generate income while maintaining a connection to the underlying stock. First, income generation. The strategy uses call spreads to collect option premiums, which is fuel for that weekly distribution. Second, they use the synthetic exposure. Instead of owning the shares directly, the fund uses option, long calls, and short puts to create stock-like exposure. Now, the trade-off, you must respect. Selling calls, even as spreads, can limit your upside during strong rallies. So you're making a conscious exchange, income potential versus capped potential in a big upside moves. Now, investment objective, number one, primary objective is seeking current income with a targeted distribution rate of 25%. Now, of course, that is not guaranteed. And number two is the secondary objective, which is capital appreciation through indirect exposure to the share price and the performance of NVIDIA and Tesla stock.
Now, distributions are not guaranteed and may fluctuate based on market conditions and option premium levels. Now let's get into the early distribution discussion, and that also is going to include the ROC, the return of capital. As you can see, these funds are paying about 23 cents to 26 cents per week per fund. And based on the current price, it gives a 24% distribution yield. Now, there's two key points on the return of capital. And the first one is early ROC numbers are preliminary and can change. And two, the ROC is not automatically a good or a bad, but it's a signal you should monitor. In plain English, if the distributions are being classified heavy as ROC, it may mean that the payout is not fully supported by the income in that period. That doesn't tell you everything by itself, but it does tell you to pay attention to the NAV trend, distribution consistency, and how the option engine behaves across different voluntary markets. We put it on the screen here that you can see the estimated ROC. For NVIDIA, you're looking at 86% and 97%. For Tesla, 94, 93, and 57. So the funds early, this is basically about here you're seeing the month of December's distributions, and they're using heavy ROC. Now, this is where we have to get disciplined. The early performance from the month of November, which is a very, very short time window for investing, but within that early window, the NVIDIA fund, NVIT, has performed with a NAV of about 3% down, and the market price has been down by about 2.5%, 2.75%. While the TST of the Tesla, the NAV performance is actually up by about 5.5% to 5.75%. And the market price is almost 6% increase. Now, we have to flag this with an extremely short performance window, and short-term results are not reliable indicators of future results. So we have to treat this as an early read, not a verdict, not an endorsement to buy, but showing you the real core of what the funds have done in the past 30 days. Now let's talk risk, and clearly, as these funds have risk. The first is that upside risk and options potential risk. The call writing approach can limit the upside during strong rallies in NVIDIA and Tesla, controlling the growth of the funds. The second is going to be that distribution and targeted risk. And distributions may be very significantly or eliminated entirely. And the 25% target is a management objective, not a guarantee. So we have to keep an eye on that at all times. This is exactly why I don't evaluate these funds based on one payout or 1 month. I always have had a standard goal for me personally is you have to have at least 3 to 6 months of data to even think about making a decision. I evaluate them on the distribution pattern, the NAV behavior, and how the strategy performs across different market conditions. Now we're going to give you something here. Hopefully it will help you out. And if you're going to follow these funds responsibly, this is a weekly checklist I personally use on my funds and hope this can help you. Distribution levels. Is it stable, rising, falling? What is the direction over time? The NAV trend. Is the NAV holding up relatively to the payout pattern? Are we seeing NAV erosion? The underlying volatility. Option premium depends heavily on volatility. So watch NVIDIA or Tesla stock for volatility. And premium discounts to the NAV. Are you buying at a premium or are you buying at a discount? And then the ROC, the return of capital signals. If the ROC is always high, you have to note it and track whether the NAV is paying the price or is it paying out distributions. So that's the question. Are you getting your money back, which is really ROC, or are you actually just getting actual true growth in distributions? So let's wrap this all up here. The funds are designed to seek a targeted income plus some participation in the NVIDIA or Tesla through a synthetic exposure and a call strategy overlay. And once again, that 25% target is a management objective. It's not guaranteed yield. It's not total return. Its distributions may significantly change or actually be at zero. So the real thing that we have to do here is we have to understand, and we showed you that the ROC, the return of capital, is between that 94 and 98% range. Now, at first, it's not a good thing and it's not a bad thing, but we have to watch it on a regular basis and we have to monitor it very, very carefully. So evaluating the Tesla and the NVIDIA funds from this are based on distribution trends, the NAV performance, and the market dynamics. This is not promotional claims. These are high risk. These have high risk because they're high income potential. And with high income potential, you always have higher risks. So this is not a market to say these are good, these are bad, stay away, buy. We're not giving you any of that stuff. What I'd like to know, though, is tell me what you think of these funds. Are these a good alternative to the weekly pays that we've been buying? Or is it something that we might as well just stay away from? Let me know your thoughts.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.